Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are here to help you with your retirement, whether you're looking forward to your retirement or already in your retirement. I think we have something for you. You can send in your questions live. We'll try to answer them as we go here. Send them in during the week. We'll try to answer them next week. Send them to asktom@talkmoneywithtom.com, or you can put them into the chat today, and we'll try to answer them live. So you can go to our channel. We created this channel because we feel like there's more education needed in the area of retirement. You can hit the subscribe button and the bell button to get notified when we put new content out, obviously. Or you can just meet with Ethan and I, sit down with us, on a phone or the video or in the office. You can go to our website. The link is on the site here. Go up in the corner, you see a button, looks just like that, and then book a 30-minute appointment with us. We'd be happy to talk with you. So, I hope everybody kind of gets at least one thing out of today that you can kind of use to improve. If nothing else, just learn more. Even if you're working with an advisor, we found that people do a lot better in their retirement the more they know about it. Okay, so I always like to start off every week with a summary of kind of what we saw happening with the market this week. So let me switch over to the chart that we look at here. This is a great time to be an investor. I mean, really, since October 27th of last year, so almost a full year now, we've had a continuous run here. We had, some interruptions in April, August, September, but otherwise, what are those? I think the worst one was in August. It was 8.5% from high to low, was the drop. And we're right now today, as we sit, we're sitting at another all-time high, which would be the 45th all-time high for the year. And it's kind of amazing, actually. September is historically a negative month by a little bit, I think 0.6%, looking at September long-term on the S&P 500. We made money last September, even though it's kind of an election year. And again, election year 60 days prior is usually soft. Here we are in October, setting continuous new highs. Maybe we won't have as great a November, who knows? But the market is really, really going. It's going very, very well. And there's reasons for it. If you look at kind of what's going on, I mean, the Producers Price Index just came out today, which is the wholesale price index. It was down from where it was over the last couple of months. And that's a good sign, I think it was at 1.76%. So, if it's lower, that's working its way through the food chain, so to speak, right? So if your wholesale inflation is lower, maybe your top line inflation will also be lower coming forward. So we had the Federal Reserve that lowered rates by 0.5 point. The next meeting is November 7th. So you've got an environment the stock market loves, which is lowering of interest rates. The average rate of return is 14% after the first rate cut in the last 11 rate cut cycles, and money was made in 9 of those 11, right? So pretty good stats here. I'm telling you, there's a lot of things stacking up for this market to be quite decent, continue to be well. Basically there's just a momentum that's happening here, and people are buying in, and the cash flow's coming in, and maybe October becomes sort of an anticipation month in a presidential year where everybody can see the data historically that November is a good month, especially after the election, and people start buying early into that. I remember way back, we used to call it the January effect, and then it became December because everybody was anticipating January and buying December. And now November is the highest average rate every month, probably anticipating December. So, these trends over a long period of time can change as far as that goes. But this has been phenomenal, really. I'm really happy with what's going on. We are seeing still within the market itself, if you look at kind of the sectors, we're seeing this rotation that's happening on a really fast basis, almost daily, from one sector to another. All of a sudden, this sector's hot. And again, this is very similar to what I remember from 2021, and you really need to focus on the broad portion of your portfolio, right? Having all the pieces. We've seen some great runs out of small caps, then all of a sudden that kind of stops. We've seen, technology has made a couple runs here, but not enough to be as good a momentum maker as it was earlier this year, right? So that's where you really want to focus on having kind of like the Vanguard Total Stock Market Index type pieces in your portfolio that can kind of capture everything. Because in 2021, when you were trying to capture momentum in the segments of the market, very difficult because it just didn't last long enough for you to kind of get in and out and to outperform the market versus just holding on. I think VTI or Vanguard Total Stock Market Index in 2021 was up 27%, for example. So you'd have done fine to just kind of hold on to that. That's the kind of market we're seeing here. Maybe a trend develops here after the election. Maybe because of who gets elected, people start to bet on one particular area or another with anticipation that, you know, that area is going to get more attention under this particular administration, whatever that is. But we haven't seen that for a while, really since about May. You know, May, June timeframe is when kind of the trending stopped as far as that goes. So nothing wrong with that. The broad market, which the S&P 500 does a decent job of representing, doesn't have small cap, right? But it has some mid cap, mostly it's large cap, but still very, very good index. So if you look at what's going on, there's a change today that happened here. The top part there shows by increment, so hourly, daily, weekly, or monthly. So when we're looking at the chart in those different time frames, it's kind of fractal. You know, you're looking at each segment in different time frames, and as of September 19th, they're all green, and they haven't changed, right? Still green. Everything is in a primary uptrend. Had a couple times here where the hourly turned down, and those downturns that started, you know, July, mid-July, and beginning of September, but everything is green. Now, going back to June 3rd, we have had everything green except for transportation, right? It's been red. Today, it's just gone green. So I don't know, you can't get much better than what's happening here. So the second part there is the market breadth. It's looking at all of these different segments of the market as a whole to see if they're in a primary direction, up or down. It's not meant to be a pre-warning indicator. We don't really look for that pretty much because we don't believe you can get in and out on a short-term basis per se. We're looking more for confirmation that this is a big downturn and it could get bigger and bigger. Those are the ones we want to try to make some changes to the portfolio to try to step out of the way. And again, you have to be careful. If you get in and out all the time, you know, last year was such a great example. That was a pretty violent 10% downturn that happened last summer. You know, it would fake up and not quite make it and then fail, you know, and lots of articles about, oh, we're going to fall a lot farther, you know, what have you. And if you didn't have the right setup, you might have gotten out, and man, you would have really missed, because like the first October 27th was that bottom. And I think the first week after that, it was up 5%, and it was up 8.9% for the month of November as a total. So you can miss out on upsides really fast if you're trying to get out on these smaller moves. Now, what you want to see is the primary direction changing to the downside, and that hadn't happened at that point in time. So that's why we stayed in, for example. So that's what this is to help us with, is kind of combining with the primary direction, you know, what is going on. And we can see, for example, when the primary direction changes, you'll see the hourly, daily, monthly, and weekly start to all go red, right? And so that's, you know, confirming, you know, that we're in a much bigger downturn, and maybe we'll have more momentum to the downside going forward also. And so the big news this week, or the big report, I suppose, was the Consumer Price Index. This is going back 5 years. So it came out yesterday. Market dropped a little, 0.2%, right? Because the expectations were a little bit better than what happened. So
they were expecting 2.3.
Yeah, they're expecting 2.3% year over year. So in this case, we're looking at this September versus last September. And the expectation was, hey, it's going to drop 2.3. It dropped 2.44. Or it ended up at 2.44, right? But the market's up today. There's some other reasons that it's up today, and we'll talk about those in a minute. But I felt very confidently that the market would shrug this off pretty quickly, only because 2.44 is the lowest, you know, top line CPI inflation rate we've had going back to the very beginning of 2021.
Yeah, I think February was the last time it was below that.
Yeah, I mean, you can see essentially it's been going more or less sideways for quite a while, right? And we're not really getting down maybe to the levels the Fed wants. Please keep in mind the Fed is not looking at this measure when they talk about 2%. They're looking at core PCE inflation, which comes out at the end of the month. We'll talk about that also. However, they're fairly well correlated. This is coming down, core PCE is coming down, but they're both doing it in the same way, really slowly in the last 4 to 6 months. And so the Federal Reserve lowered rates 0.5% in a time frame when inflation really isn't falling that much. And that has to do with the fact that they have this dual mandate, right, full employment, which they consider about 4% ish, unemployment, interestingly enough, and inflation at 2%. I think they're showing, I believe, that they're okay in a 2 to 3% range, which I think is, as a matter of fact, there's a whole bunch of economists that have come out and said that that's what they should do. So maybe they're listening. They haven't said anything about that. They're still talking about a 2% target, but they just did a half a point rate cut in a time frame when we're not quite there yet, and the trend is sort of sideways and not really down. They didn't want to wait until we got there because then it could go below that and we could end up in a deflationary.
You're trying to slow down a train. It's hard to stop on the dime.
Yeah, which is fine, but a half a point was kind of a big deal. So the next big piece that really has been driving the market today and kind of coming back is earnings season started. And the banks that reported earnings, JP Morgan, Wells Fargo, both had good earnings reports. JP Morgan was up 5% before the show started. Wells Fargo was up 6%. And so that's exciting. And we've got, earnings season is here, right? We're going to get, and the big week is that week where we get Apple and Microsoft and, what have you. And of course, the really big week is way late is NVIDIA, because that's seen as sort of the bellwether for the whole AI movement as far as that goes. Again, we talked about last week all the catalysts that are out there that are driving the market, and that hasn't changed. I mean, this is continuing to kind of go and go. And so one of the catalysts will be future rate cuts. And so, again, we presented this last week. Not too long ago, it was about a 56% chance we'd have a half a point rate cut. Last week, that disappeared because the data is coming in. It's showing inflation isn't falling as fast, so people are thinking, okay, maybe we don't need a half point. And the jobs report came out, it was very good, those types of things. So we were at a 3% chance that we would have no rate cut. Well, that, as of this week, as of today, is now up to a 10% chance. I'm going to go out on a limb, and I wouldn't be surprised. If you look at the minutes for the last meeting, there was quite a quite a debate about whether to do a quarter point or half a point, and they ended up doing a half a point. I think the debate this time is going to be pretty, good about whether to do a quarter or zero. I think zero's on the table. The data continues to come in. It's showing inflation is doing okay, but it's not coming down a lot. The unemployment report, I will say, this week was the highest it's been in a year. Every week there's a thing called first-time unemployment claims, and it actually been trending down for the previous 4 weeks quite nicely. But then this week was the highest it was for the past year. So that bodes towards doing a rate cut, right? Versus then we see CPI was a little bit higher than expected. That bodes toward doing no rate cut.
Yeah, I believe the Fed will be able to see one more jobs report prior to their
that one more jobs report, and of course that weekly unemployment claims comes out every week. So that's something that they'll be able to see. And there won't be an inflation report. Oh no, there will be an inflation report. The PCE will come out at the end of this month, so that'll be interesting to see. As far as that goes, so this is what the market's looking at right now. But keep in mind, if you step back from kind of the day by day stuff and you look at what's going on, the market is a leading indicator, okay, for what is going to happen in the economy. That confuses people a lot. I remember my grandmother used to always ask me, why is the market going up when there's, unemployment is going up, and because the market's looking 3 to 18 months forward, and unemployment is a current lagging indicator, right? And so, and that's true for so many things. And I'll mention this again, but the leading economic indicator, the LEI, it's a big one. It's been very well followed. Has only 10 indicators in it, and the S&P 500 is one of them. So if you see the S&P 500 doing what it's doing right now, we would expect the economy over the next 3 to 18 months, and more importantly, the earnings of companies, which is really what the market's looking at, to continue to improve during that period of time. When you see the market turning down, things might be rosy, because what we have to realize is there's so much money in the market that it attracts all of this resources and infrastructure and intelligence to look at what's going on with earnings in the future. And so, it's not insider trading. It's just understanding at a deep level every one of these companies. They're tracking, retail organizations by using satellite imagery of their parking lots and how many cars are coming and going. I mean, you wouldn't believe how much money goes into determining, what future earnings might be. And so you don't need to spend that much money yourself, in my opinion. Watch the S&P 500. It's why we talk about it all the time, because when it starts to turn down, expect that there would be some hard times coming as far as that goes. The opposite of that is happening right now. Expect earnings continue to do well when the S&P 500 continues to do this well. There's always this caveat that I always throw up, that there are things that can happen that would throw this train right off the rails, right? I always use the China, invading Taiwan scenario, but there's others, obviously. But barring those, looking at how the market works, looking at the momentum that the market has, looking at, the future of what's going on, this is going to continue. I mean, we're still early in a typical upward market move, right? And so, we'll see. The down market that stops the bull market, the up market, is a 20% down market. And so theoretically, we're still a ways away from that, looking at the average length of term that a market runs between 20% down market. So, we'll see how that plays out. So anyway, that's the summary for this week. Great time to be an investor. We're over 5,800 on the S&P 500, which is awesome. I think we have a good shot at getting over 6,000 if we continue on this pace, which, on a percentage basis isn't that far from here. It will be interesting. I bet you we have some trouble getting through 6,000. We always do. These big numbers, there's lots of resistance there. People are selling at those high points, but I wouldn't be surprised to see us close over 6,000 this year based on what we're doing at this time, right? So that's the summary for this week. Very happy that you're able to join us for that. Look forward to doing it again next week. All right, let's start with our first question.
So why did the market shrug off the higher than expected CPI report? Is inflation becoming a non-issue at the current levels?
Well, let's take a look at the chart again too. There's two things that the Federal Reserve is looking at, right? It's their dual mandate, inflation and employment. The focus has shifted, in my opinion, if you're to pick one that's more important right now, it would be employment, right? Because we went from unemployment from 3.4% all the way up to 4.3%. We eventually dropped back down to 4.1 now, but it's still a roughly 11 million jobs lost. So it's a lot of human, misery that's being caused by raising rates. And so I think, feel like the 2 to 3% range is okay. So the market's starting to see those same things, So, for example, here's the top line CPI inflation chart came out this week, right? 2.44%. The overall trend is okay, right? I mean, I'd love to see it dropping a little bit faster over the last several months here, but the overall trend, look at this 5-year period, is pretty good. And of course, at 2.44%. That was early 21 that we had that the last time. So we're getting back down, I think, into a more normal range. There is always that threat that it blows up again. And I tell you, you have to understand the history. Nothing scares the Federal Reserve more than what happened in the 70s. Because what happened in the 70s is similar to this so far. Raised rates because inflation was coming in, started to tame inflation. Unemployment picked up. They have a dual mandate, so they started to lower rates, and then things got out of control. And we ended up with a 19% Fed funds rate. It's roughly at 5% now. And so they have talked about that many times in different interviews. Chairman Powell of the Federal Reserve has talked about they do not want to be the Federal Reserve that has that happen again. Again, when you go back and dissect that some, the thing that I see is that oil prices went crazy during that time frame. Went from $4 to $40 a barrel. So we're at $75 a barrel now. If it went to $750, yeah, you would have 19% Fed funds rate, in my opinion, because inflation would go crazy. The problem is we're not as dependent on oil as a world, and that was really OPEC at that time, controlling that. They don't have as much power now. The U.S. produces a lot of oil. We're a net exporter, and we're using a lot of alternate energy sources that we weren't using back in the 1970s also. So it's a little different time frame, but that's why they're concerned about inflation. But I think at the moment they're more concerned about the employment reports that are coming out. And that report that came out on Friday with 245,000 jobs when roughly 145,000 was expected. Those numbers may be a little bit off, but you get the idea. And that's what the market is really focused on, because that's what the Fed seems to be focused on the most. So they may be lowering rates again by a quarter point or what have you, November 7th, because of we're still at what, 4.1%. I'm sure they'd like to get that a little bit lower.
Yeah, they're just trying to get into kind of a neutral spot, not restrictive,
Right.
but not expansionary. So they just want to get kind of to the sweet. They're looking for that Goldilocks zone where unemployment is okay, but not not somewhere in the 4%, like below four is their
Right.
ideal
Yep.
with the economy still growing.
Yeah, they have this thing called the neutral rate. It's really kind of confusing even for me. You read it and nobody really seems to know exactly what it is, because so let's just say the neutral rate is 3% and we're at 5, right? Just making up numbers. And so what that means is that we're currently in a restrictive posture. The economy is going to continue to slow as long as you stay in that restrictive posture. So as they move rates back down to get closer to the neutral rate, which is probably where we should be right now, although inflation isn't exactly where it needs to be. That's one of the reasons that they'll be looking at cutting rates and bringing it back down, just because from a pure logic standpoint, it makes some sense right now to continue to move towards a neutral rate to avoid a hard landing, in that 3 to 18 month period coming forward that it takes for rate increases to have an impact. It has had an impact. 11 million people are unemployed that weren't unemployed kind of before they started, and so getting that back and kind of getting a even healthier job market would be something they're probably going to try to do. So yeah, I think that the focus has shifted from raising rates, holding rates up, to now down, right? And I bet you they just continue. There may be some periods where they hold it, and maybe it doesn't come down every time they meet. Matter of fact, a couple of the interviews this week with the Fed governors said, maybe one out of the 2 meetings they would do a rate cut. A few of the others said that probably both. So you're looking at 0.75% cut for the year altogether, including what happened, or 1%. Both of those are decent. Market's going to like that. I'm telling you. The market loves when interest rates come down because it makes it cheaper to operate business. Yeah, as a whole. So that's a good question.
So what factors go into testing a Roth conversion scenario?
Okay, so a Roth conversion is where you have money in a IRA, a 401k, some type of what they call tax-deferred vehicle. It just means you put money in, you didn't have to pay taxes when it went in, it grows, and then you take money out and you pay your taxes on your growth later, okay? You can, no matter what your income level, convert some money out of your IRA account, 401k account, any of those, 403b, 457, there's a bunch of them. You can convert that to a Roth IRA. When you do that, whatever you take out, let's say you take 100,000 out, you've got to pay taxes.
Yeah, and it's ordinary income tax,
Yes.
not capital gains.
Right, yeah, because that's what you avoided when you put it in, which makes sense. But then once you get it in there, it can grow tax-free, right? Really, for the rest of your life. And theoretically, even 10 years worth of your beneficiaries' lives, as far as that goes. So, it doesn't always work. You have to take a look at all of the numbers. And so that's what this is talking about. What are the factors? So one of the biggest factors, I believe, is just what's your current tax rate?
Yeah.
Right
what
now.
tax bracket are you in now? How much income are you using now?
Yeah. And so if I take $100,000 and pile it on top of my current income, how much am I going to pay on that? So if I'm already in the 32% bracket and I'm going to bump myself up for part of that to the 35% bracket, that's pretty high. And when you run, and so here's how you have to do this. So you have to run a financial plan. You can't just do this, off the top of your head. And then that plan can then show conversion capabilities. We have a great program for this, and figure out the taxes on every conversion, some growth rate on that. And so, yeah, that would be the key issues, right? What's the growth rate going to be, expected in that tax-free account? what tax bracket am I going to pay on, which has to do with what I'm already in, because I'm adding to that.
Yeah, and there's also some health factors. What's your longevity? Because Roth conversions benefit more longer you're able to let them grow.
That's right. That's right. So because you're getting your tax money back in this tax-free growth, right? I think one of the other factors that is quite important, and I think is quite exciting about this, is having some money outside of your IRA or 401k to pay the taxes. So in other words, if I take that 100,000 out and I send 30,000 of that to the IRS and the state, if you have state tax, and I put 70,000 into the Roth, if you run those numbers, if you're in the right tax brackets and your kids are going to be in the right tax brackets, your beneficiaries, it still works. But what really works is when you can pay that 30,000 with other monies that you have outside of your IRAs and 401ks, and put the full $100,000 into that account. Because what just happened was that the 100,000 that was, say, in your IRA is not worth 100,000 to you. Because when you take it out, you got to pay taxes. So it might be worth 70,000 to you. But if you can take 30 out of your other pocket over here and put that together with that 70 and put it in 100,000, now you have 100,000 growing tax-free. That's really powerful. And so you've basically been allowed to increase the net value of your retirement plans. If I have $1 million in a 401k, I could, which is worth maybe 700,000 to me after tax, just making up some numbers, more or less. I can have $1 million in a Roth IRA that is actually worth $1 million. I just added $300,000 to my retirement plans, and I'm adding them to a vehicle that allows it to grow tax-free. Super powerful, right? I mean, there's no doubt. But not everybody has the money outside. So that is one of the factors that comes into testing Roth conversions, because you're going to have, what you're trying to do in these financial plans and this testing is you're trying to see, over your lifetime, does your net worth increase?
After taxes.
After taxes, right? And for your entire, you and your beneficiaries, is it better? How much am I ahead? I'm ahead $10,000. Okay, probably not worth doing it, right? I'm ahead $1 million. Oh my gosh, that's worth looking at.
Yeah,
right?
you want enough wiggle room for the uncertainties in life. You know, your plan, you're guessing what age you're going to live to, but if you live shorter, then you want to have that wiggle room to kind of make up that difference.
Yeah, we were working on a plan this week where if they live to age 100, you know, which is hard to do but it happens. I think they had 185,000 or something, make up a number, you know, and it really just wasn't enough wiggle room, because if they live to age 90, they actually, the net worth dropped.
Yeah, they would lose money.
And so it doesn't make sense. Versus say, hey, if that would have been $1 million and it dropped down to 700,000, that's still worth it. Right.
Yeah.
And so longevity is a piece of that. That's one of the factors that goes into testing, is that kind of longevity piece. And we can check different ages. What happens at 80, 90, 100? Does it still work under all of those? Is it a high enough number to make up for the angst of paying taxes on these conversions?
Yeah, because in the long run, if you live long enough, you save money on your taxes, but you have to live long enough.
I'd say one of the other maybe offbeat factors that goes into Roth conversions from our experience is the willingness to pay the tax. We've done a lot of Roth conversion analysis where it works. No matter what age they live to, basically, it works. It just happens to be the other factors all work out. And yet they don't want to still do it because they just can't stomach paying the taxes, right? Now, they're going to pay the taxes anyway. Somebody's going to pay the taxes. The beneficiaries are going to get hammered with the taxes. They're going to get hit with taxes once they get into required minimum distributions. They're maybe even going to get hit with higher Medicare costs and all. So they know all these things and still don't want to pay the taxes today. That's okay. You know, everybody's got a different outlook on how things work, but that is one of the factors. You have to be willing to do it.
And there's also some uncertainty with Roth conversions. You know, you never know where tax rates will be in the future. So you're making an educated guess right now based on what you know. Right. And so, you know, we know that tax rates are to sunset in 2025, at the end of 2025, if nothing changes. But if something changes, then your Roth conversion scenario could change possibly.
That's right. Yeah. So one of the other factors is what is the tax bracket for your beneficiary? Because you'd look at it and say, okay, if my beneficiary is in a high tax bracket, then it might be better off giving them a tax-free asset. If my beneficiary is in a very low tax bracket, even with the conversions that they would do, or not the conversions, even with the withdrawals that they would have to do out of this, then it does, you might be taking it out. Let's just say your tax bracket is 32% and your beneficiaries, even with the required minimum even with the distributions, is at, say, at the 24%. They're actually getting a lower tax rate than you are. And when you do those calculations, that might offset the tax-free growth that you would get right out of that. So that's part of the factors that go into this. So this is a very fascinating area to us. It's something we work on all the time. And you really have to understand what you're doing and at least look and see if it makes sense, right? Everybody should look and go through a planning process to see if a conversion makes sense. No matter whether you think it makes sense or not, let us do it and go through and see if it makes sense. And we'll tell you, because we don't have any, if you've got your money in an IRA with us or Roth IRA, we get paid the same. We're just trying to help maximize the situation so that you have, the best scenario for you and your retirement, and your beneficiaries have the best scenario for them upon inheritance. That's all we're trying to do. And these programs will allow us to at least, get a pretty good, view of what's happening. So there are a lot of factors that go in, and it's very personal. And it's a funny thing, there's a Social Security, and when you take it, is so controversial, and everybody runs around saying you should do this or this. You know what? They might all be right because there's so many factors that go into that calculation that, your friend might say you should do this with Roth conversion because it works for them. It might not work for you, or vice versa. Oh, no, you don't ever want to do Roth conversion. It doesn't work for these reasons. But when we look at your situation and your numbers, it works great. So it's personal. You can't go by this group feeling of what's going on. And it's why it is, I'd say Roth conversions and Social Security, when to take it, are two of the more controversial areas we deal with. Mm-hmm. And the reason is because it's different for each person depending upon the factors that they have in their situation. And so, we don't have anything, we don't control Social Security, but we can show you, what makes the most sense, at least from the number standpoint. Anyway, so that's a great question. I like it.
So I inherited an annuity. How do I decide on a distribution option?
Okay, so inherited annuity, kind of depends. There's two different things, right? Is it an IRA, what they call qualified, which just means that no taxes have been paid on any of that money, right? Mm-hmm. Like it's an IRA annuity that has invested into an annuity or what have you. 401ks can go into annuities now too, so it could be in 401k. Or is it after tax dollars, which they call non-qualified?
Yeah, so right? You have some sort of cost basis, but then the rest is kind of growth.
So distribution options, okay, first of all, you've got to look at the overall tax category, qualified, non-qualified, to figure that out, because that does have some restrictions on what you can do.
Also the size, just the size of the annuity. If it's a $10,000 annuity, is $100,000, $1 million, that affects how you decide.
Very much so, yeah. Because if it's $10,000, you might just want to lump sum it out of there and get rid of it, and just make your life simpler. If it's $1 million, you lump sum that out, you could get wiped out on taxes, right? You might want to take that over some periods of time. So there is a chart here for kind of that we have for this. So you can take lump sum, right? That makes sense in some cases, and you can do the math on this and figure it out. Okay, should I take it out? I'm going to lose something in taxes, but I'm going to put it over here. I'm going to gain, because the annuity has some restrictions on, how it can be paid out, and often has some higher costs.
Higher costs, and then also restrictions on investments. You're only allowed what's the actual, and sometimes this annuity was set up for whoever you inherited from, so it might not fit your use case either. Yeah,
something for an 80-year-old might not be as good for a 40-year-old, the way it's set up and such too. So you might be better off. And if it's a IRA annuity, then you might be able to roll it over, and there's all kinds of things. So 5-year rule, this lets you spread out the payments, from an inherited annuity over 5 years, paying taxes, a little at a time that way. Yeah. So again, it makes more sense if that's a bigger one to use that, right? A non-qualified stretch. So this means that this is a remainder. You can stretch the payments over the rest of your life. Okay, based on the actual payment amount. you get this life expectancy payout, which can be very nice to have an income coming in.
Yeah, you get a guaranteed income for the rest of your life, and you can, in some ways, kind of outlive that benefit and then earn money by living just longer than the expectation.
Yeah, and then the last one, you can just choose some type of a periodic or annuitized payout, which is where, you choose how long you want to get paid. So I'm going to get paid for the rest of my life.
Yeah.
I want to get paid for the rest of my life, and if I die, I want some of the money or all the money, depending what options you choose, to go to my spouse. You can say, okay, I want it to be at least 10 years or the rest of my life, at least 20 years or the rest of my life.
Yeah.
And if I die within those 10 or 20-year periods, my beneficiaries continue to get paid until that 10 or 20-year period is up. There's a lot of options inside of that, some of which are really interesting. And again, it matters what else you have going on.
Yeah. What's your income?
Right.
What is your needs?
Yes, exactly. What other assets do you have? How important is this to you? Would make a difference, because once you annuitize something, let's say you get a payment for life, that's great.
But you're stuck.
But you don't have any access to the money. So if I take a $1 million annuity and annuitize it, I'm going to get X amount per month, which is fantastic for the rest of my life. It won't stop. But if I have a big emergency and I don't have any other money, that $1 million is also gone too, because I'm in this contract for this. So again, it can be an awesome option. It can be a terrible option. As with most of the things in financial planning, it really depends on your situation, kind of what you're dealing with.
Yeah, and you can also do a 10. You don't always have to distribute the funds too when you inherit it. So say it's a non-qualified, you can do a 1035 exchange into a annuity product that maybe fits better for you. So you could, defer to your retirement, then you can actually start using it. Similarly, you can do rollovers into an IRA too for a qualified annuity.
Yeah. So lots of options. Again, you got to look at it from a personal standpoint. Understand what all the options are. Understand how they impact you. Understand, the ones that would work best for you with your other assets and incomes. Yeah, and taxes, tax rates for that matter.
So why is the 2025 cost of living adjustment for Social Security so low? A lot of times you see it as called COLA, but it's...
Yeah, so every year in October, the Social Security Department announces, how much the increase is going to be for last year. I think it was 2 years ago. It was 8.9%, because we had high inflation or what have you, 8.7%. It's 2.5% for next year, right? So we do have a chart that came from ARP. I think is quite interesting. 2.5%. If you look at the chart, first of all, yes, it's lower than it was in the last 2022 was 5.9, 23 8.7.
Yeah, so since 2021.
Yeah, so since 2021, it's been higher than that. So we're kind of getting used to that. It's kind of nice. Of course, the cost of everything we're buying is going up too, so we're not netting much out of this. However, if you look long term, if you look at that, as a matter of fact, I was looking at this today. I mean, from 2010 to 2021, there aren't that many times, 2 times, where it was paid out more than 2.5%. So that's a huge stretch of time. Look at 2010, 2011 was 0, 2016 was 0, 2017 was 0.3.
Yeah.
Inflation was really low in that time frame.
Yeah, and I think because inflation is starting to normalize, your COLAs are also going to normalize too.
Yeah, that's right.
And so the interesting thing is Social Security doesn't use the actual CPI. They use a subset, which is called the CPI W, which is urban wage earners and clerical workers. And so it usually is pretty close to the COLA, and that are pretty close together, but there is some periods where CPI will be, or the COLA will be lower than inflation, and other periods where the inflation will be higher.
Yeah, it was something that they did. I don't remember what year ago it was, but that they basically monkeyed with the COLA, and so they're using this CPIW. It's like a modified CPI that they think more represents a retiree's lifestyle. Probably less reliance in that calculation on rent, theoretically, but that is overall kind of has been a little bit lower than CPI itself. I wouldn't be surprised if future generations don't have even a more modified CPI, Social Security, cost of living increase, because this becomes quite expensive. It's one of the things that really makes it difficult for Social Security to keep going.
Yeah, especially when you have those big years.
Yeah.
A few of those big years, it kind of compounds on yourself.
That's right. Yeah, exactly right. Because 2.5% on top of what we've had for the past, 3 or 4 years is a fair amount.
Yeah,
from a dollar standpoint.
they're saying the average person will get $50 more
Okay.
for their benefit.
Yeah.
So I think it's $50 a month more. So that's a decent amount of money.
It has to. The weird thing with Social Security, of course, they take your Medicare for most people out of Social Security, and you can have an increase in Social Security and actually a decrease in your net amount because, and that happened a couple years ago. Maybe that was 2021. They had that Alzheimer's drug that came out right before they were going to do the calculation for how much Medicare should be, and I think it was really expensive per year, and they weren't sure what was going to be used, so they just made a high number, and people, I think it was 2021, it went up 1.3%, and people's Social Security actually went backwards because Medicare went up so much. They eventually actually lowered Medicare once they got a handle on how that drug was actually going to work out, and that was what Bristol Myers Squibb, I believe, had that drug, Alzheimer's drug. So that factors in also as to what you're really going to get on your check is what they're going to do with Medicare.
Yeah, after withholdings, all that stuff.
Yeah.
But usually these nets they may not keep up, but they at least give you some sort of that.
Oh, it's better than zero, that's for sure. It's actually really important. The average American 65-year-old has very little in assets, and so Social Security is incredibly important. They always talk about cutting back on Social Security and all this. It's the reason they can't is because Americans aren't great savers. We have a very low savings rate as a country, and so it's become this, subsistence level thing that would be devastating to really cut or to really modify. What they probably need to do is for future generations, and they've already done that. For my father, full retirement age was 65. My full retirement age is 67.
It might be 70 for me.
Yeah, it might be. And so that's, I'm going to get less than my father did per dollar put in there.
There's also expectation that you'll live longer too.
Well, they've notified me way in advance of that, which really helps, right? If taking current retirees who are currently getting Social Security and messing with their Social Security. First of all, that hasn't happened that I know of ever.
I don't think they would. It's too powerful a voting block.
It is. And so, but they worry about it. I've had lots of clients that worry that their Social Security is going to get cut. I think, their grandkids' Social Security is going to get cut. Maybe even their kids' Social Security is going to get cut. But I remember Alan Greenspan testifying in front of Congress saying, look, you need to notify people well in advance because this is coming.
You have to. It takes some time to save for that.
So at least I know going into it that full retirement age wasn't 65. It's going to be 67. I can factor that into my planning. I can save a little bit more, those type of things. So anyway, that's the COLA piece. It's really fascinating. It's interesting how it works. It's nice that they have it. 2.5%. I don't know what the average is on here, but it's up. That's probably someplace in that neighborhood, actually, just looking at the chart. But yeah, anyway. All right. We have time for one more, or we want to wrap it up?
We can try for one more.
Okay. Can't get this back. There we go.
Oh, there we go. So this will be a quick one. How do I keep my partner in the loop? Who doesn't really take an interest in the financial side of the household, and it's kind of I kind of manage it in whole.
Yeah, I probably have about a quarter of the clients that I meet with where I just meet with one of the people in the household. And, we always invite the other ones. We always, try to make them known. But you get a division of labor in all households, and so somebody might pay the bill, somebody might handle the investment, somebody might do all of it. It's kind of depends on, what's your expertise and how's their relationship structured. But it's still important, in my opinion, to somehow notify the other person of what's going on as much as possible, because there's a chance that you might not be there at some point in time, right?
Yeah, and so, what are the big decisions that the household has to make financially? You should include them, let's say we're buying a car, maybe hey, we can only afford this much, that's our budget, and this is why I got to this budget. That way they're on the same page when you go shopping, and they don't, because if you just give them a number, people kind of just guess and check.
Yeah, exactly. And then the other one is just in terms of letting them know where things are, right? And maybe being, or if you're going to be solely in charge of all the money for some reason, uh, be a little bit organized with that. Have a folder someplace, or a binder someplace where all the account numbers are. Just simple stuff, just so they can figure out where things are. I remember a lady walking into the office, coming into her first appointment, and she had a grocery bag. Her husband had passed away about 9 months earlier. The grocery bag was filled with envelopes. He took care of all the money, but he was very disorganized. He seemed to, whatever he saw that looked interesting, he would put money in. He had so many accounts. We spent the whole time just opening these envelopes and trying to figure out what was in there. It took us over 3 years to find all of the assets. We had to wait for other statements to come in and what have you too. So, if be a little organized and let your partner know, hey, go to this file cabinet drawer here. I'm going to keep it all in here. It doesn't have to be anything really sophisticated. Just here's the account numbers and the names of the institutions, and
Yeah.
get you started.
Yeah, because like once you're able to contact that institution, you can get all the information, but
Right.
it's knowing which institutions to contact is the
Yeah.
hard part.
This lady had no idea, nothing, didn't know anything,
Mhm.
didn't know if they had a mortgage, didn't know, what investments they had, didn't know she was getting, there was dividend checks inside of this, grocery bag. She just didn't want to deal with it. Obviously with the death of a spouse, it's really a tough time to deal with things. And so, make that a little bit easier if you're going to be in charge. But I don't think it's mandatory that you both be involved. I think it's probably better, but at least if you're going to be the only one in charge, just have a little organization in place and let them know where to go, and that'll solve almost
Yeah,
everything.
it'll save them future headaches.
Yeah, that usually works. All right, well, that's the end of our show today. I want to thank you very much for joining us today. Look forward to being able to see you again next week. Send in your questions between now and next week that you want us to answer, and we'll work on those. Ask Tom at talkmoneywithtom.com. Go to our channel, subscribe to the channel, and get notified of new things by hitting the little bell button. Come in and set an appointment with us if you have some other questions that you want us to ask on a one-on-one answer on a one-on-one basis. There's a book appointment button on our website, and you can push that and schedule a 30-minute time with Ethan and I. So anyway, look forward to being able to see you next week. Thank you so much for coming this week, and we'll see you again. Thanks.